Marcus is 31 years old and he just did something that felt like throwing away 14. He put in his 2 weeks notice on a Wednesday, and by Friday, HR had sent him a document that made his stomach drop. Vesting schedule. Unvested balance forfeited upon termination. 14,300. That number wasn't in some account he'd never touched. It was sitting right there in his 401k dashboard for 2 years. He'd looked at that balance 100 times. He'd mentally spent it actually. On Friday, he found out that number was never really his. It was a number his employer let him look at. My name is Horizon, and I spend way too much time reading the fine print on retirement plans that most people never open. If you've ever changed jobs, or you're thinking about it, or you just assume the number on your 401k app is money you actually own, hit subscribe. There was a single sentence in Marcus's plan document, the one he was handed on his first day and never read, that told him this exact moment was coming. Let's start with what vesting actually is, because most people have a version of this in their head that's dangerously wrong. You probably think of your 401k balance as one pot of money, all equally yours, growing together. That's not how it works. Every dollar you personally contribute from your paycheck is yours the instant it lands in the account, fully vested day one, no exceptions. The employer match is a different animal entirely, a conditional promise, a reward for sticking around long enough. Until you hit that threshold, every dollar of it can vanish the moment you walk out the door, not reduced, not partially kept, vanish. This is not some obscure loophole. The vast majority of 401k plans use either a cliff vesting schedule or a graded vesting schedule. Cliff schedule means you get 0% of the match until you hit a specific tenure marker, often 3 years, and then you jump straight to 100% overnight. Graded schedule spreads it out, maybe 20% a year over 5 years, so you're always partially exposed until the very end. The plan is built so that the moment you're most likely to leave is exactly the moment you have the least ownership of money that's already showing up in your account balance. Let's put real numbers on Marcus. He makes $78,000 a year. His company matches 50 cents on the dollar up to 6% of salary. 2 years, that's $4,680 of employer money sitting in his account. Add growth at a reasonable 7% average return, roughly 5,100. His plan uses a 3-year cliff. Marcus was 2 years and 4 months in. Wasn't close in the way that feels close on a calendar. He was 8 months away from a check that would have doubled in value. Instead, he walked away with exactly 0 of it. Here's the number that actually matters, though, and it's not $5,100. It's what that $5,100 would have become, roughly $38,800. Marcus didn't lose $5,000. He lost the future value of $5,000, and that number is nearly 8 times larger. Vesting doesn't apply to your contributions. It never has, it never will, that's federally protected. What vests or fails to vest is only the employer's side. Your 401k statement doesn't distinguish. It shows you one aggregated balance. There is no asterisk on the homepage of most plan dashboards telling you that a third of what you're looking at is provisional. You have to click into a specific vesting summary, a page most people never knew existed, to see the actual breakdown. Let's talk about why companies build it this way, because understanding the incentive on the other side of the table changes how you should think about your own decisions. Employee turnover is expensive. Recruiting costs, onboarding costs, lost productivity while someone ramps up. Vesting schedule is a cheap, effective retention tool. A retention mechanism disguised as a benefit. It's marketed to you during recruiting as pure upside. We match 50 cents on the dollar. Nobody in that interview mentions the cliff. Should this change how you think about your job? The honest answer is yes, but not in the direction most people assume. Up your plan's vesting schedule specifically, not your balance, the schedule. Find your vesting percentage as of today. Find the date of your next vesting cliff or graded increase. Multiply the unvested employer dollars by the percentage you'd forfeit if you left today. Project it forward to retirement age at a reasonable growth rate, because that's the number that should actually inform your decision. A $5,000 forfeiture today isn't a $5,000 decision if you're 35 years from retirement. It's closer to a $40,000 decision. I want to be fair to the other side of this. though, because there's a real counterargument. If you're leaving for a role with a 20% raise, staying 3 extra months to protect $5,000 while turning down tens of thousands is its own kind of financial self-sabotage. Right now, for most people, it dictates zero career decisions because most people don't even know their own vesting date. There's a second layer to this that almost nobody talks about, and it's arguably more expensive than the vesting cliff itself. It's called leakage, and it's the term the retirement industry actually uses internally for money that exits the system early and never comes back. When you leave a job, you generally have a handful of options for what happens to your vested 401k balance. You can leave it with your old employer's plan, roll it into your new employer's plan or into an IRA, or you can cash it out. Here's where it gets ugly, because the data on what people actually do is genuinely alarming. A significant share of workers, particularly those with smaller balances, choose to cash out their 401k entirely when they change jobs. Balances under $1,000, plans are actually allowed to force a cash out automatically. Balances between $1,000 and $7,000, plans can force a rollover into an IRA you never chose, often into a low-yield default fund. The cost of cashing out young is brutal and mostly invisible in the moment. You pay ordinary income tax on the full amount, plus an additional 10% early withdrawal penalty. A $10,000 balance becomes roughly $6,800 in your pocket after taxes and penalty. 7% average growth over 30 years. $10,000 becomes just over 76. People aren't just losing 32% to taxes and penalties. They're trading a $76,000 future outcome for a $6,800 present one. They're doing it in a moment of financial stress, moving apartments between jobs, credit card balance climbing. This is the same psychological trap as the vesting cliff, just running in the opposite direction. Let's bring in Priya here, because her situation shows a version of this that's sneakier than either Marcus's cliff or a straightforward cash out. Priya is 29, and over 6 years she worked at 3 different companies. Each one had a decent match. Each time she left, she meant to roll the balance over. Twice, she actually did it eventually, but not before the account sat for 8 months and 11 months. During those combined 19 months, while the market returned roughly 11% annualized, her orphan balances were earning something closer to 2%. The gap between what she actually earned and what she would have earned invested normally works out to somewhere around 700. Priya has now changed jobs 3 times in 6 years, which is close to the current average tenure for workers in their 20s. If this pattern repeats over a full career, that drag compounds into a genuinely meaningful erosion of retirement savings. The third orphaned account, the one from her very first job out of college, she genuinely forgot existed. 400. There are tens of millions of forgotten 401k accounts sitting in America right now, worth well over $1 trillion collectively. So here's the actual system you're operating inside. And I want to lay it out plainly because once you see the whole shape of it, the individual pieces make a lot more sense. Employer match isn't really compensation the moment it's promised. It's compensation the moment it vests. Before that, it's closer to a retention bonus with a countdown timer you were never told to watch. Meaningful percentage of people either cash it out at a devastating tax cost or let it drift into a low-yield holding account and simply forget it exists. None of this is a conspiracy in the sense of anyone sitting in a room plotting to take your money. It's a system where the default path happens to be the path that benefits the plan administrator's cash flow and the company's retention numbers, not your net worth. Doing nothing is never neutral in this system. Doing nothing has an owner and it isn't you. What do you actually do with this? First, right now today, go find your current employer's vesting schedule, your cliff date if you have one. If you're within a few months of a vesting milestone, run the actual math. Second, if you have any old 401k balances sitting with former employers right now, and statistically there's a real chance you do, go find them. Consolidate them into your current employer's plan or into an IRA where you control the investment choices instead of sitting in a default cash equivalent fund. This takes maybe 20 minutes per account, and it stops the bleeding immediately. Third, if you leave a job, never cash out a balance over a few $100s unless you are in genuine financial emergency territory. The math is almost never close. A rollover takes roughly the same effort as a cash out, and it preserves nearly the entire value. Marcus, by the way, called his old HR department 8 months after he left, mostly out of curiosity. They confirmed it plainly. Full vesting, the entire match all at once on a date that had already passed. He'd been 8 months and 11 days away from a check that, projected to his retirement, was worth something in the neighborhood of $40,000. Took the new job anyway, and by every account it was still the right call financially. Told me the number bothers him anyway, not because the decision was wrong, but because he never got to actually make it. That's really the whole point of this video. Vesting cliffs and cash-out leakage aren't complicated once you see them clearly. You don't need to become an expert in ERISA regulations to avoid losing tens of thousands of dollars to this. You just need to know 2 dates, when your unvested money becomes yours, and how long an old account has been sitting somewhere you've forgotten about. Everything else is just arithmetic. The system isn't hiding the information from you. It's just betting that you'll never go looking for it.